All right, everyone. Welcome to the webinar. My name is Rob Miller. I am with Provisor Incorporated, and welcome to the Wisconsin Homebuyers class. Don't make these mistakes when purchasing a home. Wanted to go through a few things with you. Just a little bit of housekeeping and things. First off, on the main screen here, you can see in the bottom right-hand corner, if you want my contact information, please feel free to stick your phone up to this QR code on the bottom, and it will download my contact information. As we go through the presentation, there'll be times where we will have for questions, and please feel free to use the chat window for that. There is going to be someone watching the chat screen. To start out, I want to give you a little information about myself and my company. Again, my name is Rob Miller. I am the branch manager, senior loan officer in Madison, Wisconsin for Provisor Transparent Mortgage Solutions. I've been in the industry going on 20 plus years. So I don't want to say much more than that. I'm just because I'm going gray. But another little bit of tidbit of information: Provisor, the company. We are a smaller mortgage company. We were started back in 1998 by James Mercado, who is our company president. We fund well over 1,000 loans per year. Please feel free to look us up as a company at provisor.com. The presentation is going to cover the mistakes that people are going to make when they obtain a mortgage, whether it's buying their first home, buying an upgraded home, a second home, an investment property. Certain mortgage features that people may not know that they want to be aware of that can help them when they are purchasing. And then we'll have an option where you can book a time if you have questions after the meeting that come up. Again, please just understand that we will be taking questions throughout breaks and then also at the end, and someone will be watching the chat window for questions. Just a little bit. I mean, I believe that the main skill that you should look for in a mortgage company and particularly a loan officer is our ability to solve problems. Being able to solve problems and find a solution is one of the greatest things that can happen, which is going to make your life easier when you go to, buy a home. Our lives have hurdles. Knowing how to guide you through those hurdles and solve problems is the key to obtaining the correct mortgage that's going to work the best for you. That way you're not getting into the house and 5 years down the road, you are just frustrated about what's going on with your mortgage. So diving right in, mistake number one is not using a lender who offers all the mortgage options. Not just one option or two options, but there are tons of options that are available for people. As we go on, different loan types are the options that are going to be available for people. We have conventional loans, we have VA loans, we have USDA loans, we have FHA loans. Those are the primary conventionally run mortgages. Both VA loans and USDA loans say that they have no minimum credit score, and they don't. They also say that there's no minimum down payment. So you don't have to put money down if you don't have a lot of money to put down. Now, there are specific restrictions to both of those programs, and I can get into that in a little bit. Now, FHA and conventional loans as a whole do not have any restrictions of who can use the program, and specifically if you have to be in a certain location to purchase the program, or in the case of the VA, be a veteran. That is the biggest requirement that you're going to need to have to utilize the VA loan program. But both FHA loans and conventional loans do require a little bit of a down payment. Conventional loans are going to require a higher credit score than FHA loans, as listed here. And they're also going to require a lower debt to income ratio. And we can talk a little bit more about debt to income ratio in a little bit, but effectively it's how much money that you make as a gross figure, not after tax, but before tax, in comparison to how much your debts are, including housing payments. Some other types of loans that are available for people when they go to purchase a property. WIDA, that is a state of Wisconsin loan program that is available. And it allows people also to purchase a property, both using the conventional loan or an FHA loan with, different credit score requirements. So you might fit into one of those categories. They also do say that there is no down payment that is required. Again, it's another program if you don't have a lot of money to put down. However, there are restrictions to the WIDA loan program, just like the USDA program and just like the VA program. A couple other options that are available for people. If you're looking and you don't fit into one of the conventional type loan products that are available, we offer a program called the non-QM, industry term, or what means actually a non-qualified mortgage. So you don't fit into the basic mold of a person that's going to be able to buy a home. It's going to help people that have gone through a recent bankruptcy, whether it's the last year or the last 6 months, even a foreclosure. Individuals that are buying condominiums that aren't warrantable, so they don't meet the guidelines that are set up by the institutional investors. Maybe you're looking at purchasing a property to fix it up and then turn around and flip it. That doesn't really fall into conventional limits, but there are options available for people. And one of the biggest things is that there's people out there that are self-employed. And when you're self-employed, a lot of times you get a very good accountant available and they help you write off a lot of stuff. So you really don't show a ton of income. So you're not paying a ton of taxes. Well, if you don't show a lot of income and we can't prove it, it kind of makes it hard to get a loan and to qualify. So we do have programs that are set up for people of that sort. Maybe we don't have to worry about verifying income where we just verify deposits into your bank account. We offer, jumbo loans that are out there. Jumbo loans are, again, not going to fit into the limits set up by the overall lending programs. And that's loan amounts that are over $647,000. Now, that's a big number, but if you're looking at purchasing an $800,000 home, you may, and not putting a lot of money down, you may fall into that category. And so having that as an option is something that's available as well. One thing else, adjustable rate mortgages. Adjustable rate mortgages are mortgages that are out there that are not fixed for the life of the loan. In other words, they may be fixed for 3 years or 5 years or 7 years. Essentially, you get a little bit of a discount in an interest rate, but you're going to have to maintain your standards and your payments and your qualifications. So you are able to then refinance when that arm adjusts, because what ends up happening is if the arm adjusts, your interest rate will go up. And if you don't have that available, but it does allow people to get into homes with a more expensive home than maybe they could afford doing a fixed rate mortgage. Official lending rules versus lender overlays. So this is where I'm going to talk a little bit about the different types of loans that we just finished talking about. FHA, VA, USDA, Fannie and Freddie Mac. Now, those are companies that are sponsored by the government to offer mortgages, and they offer the conventional mortgage that we talked about before. And they have specific requirements and rules that we have to follow. So everyone across the entire country has to follow those rules no matter what. Then, of course, there are what they call lender overlays. So each individual lender, based on any of the rules that the above state, they may make it tougher while still following the particular rules because they maybe don't have quite the tolerance for the risk. So they may say that, previous screen, I pointed out that you could potentially get into a home with a 500 credit score on an FHA. Well, there may be a lender out there that says, you know what, you got to have a 600 credit score or we can't do it. They are relegating their risk and stopping people below 600 credit scores from utilizing it, even though the official rules don't require that. And so that's why people are told different things. You may go to one lender and they say, well, we can't help you. And then you go to another lender and they say, yeah, we can. And you wonder, like, why can this person help me, but this one can't? And that is because there's lender overlays. And so one lender may not have a risk tolerance for people with sub 600 credit scores, as the example, or they may tell you that your debt to income ratio has to be below 40%, which is not necessarily the official rules. So that's why you get different information. It's not that it's wrong information. It's just that you didn't go to the one place and not checking around to find out that you don't qualify. Instead of just giving up and being frustrated about it, you go to a different lender and you may be able to get it figured out. And so working with the right one that's not going to have any of those rules or overlays is certainly a great thing. At this point, I just wanted to open up the time for questions. If anyone has any questions on the section that I just went over, please feel free to put it in the chat window. I'll be looking at it. I'll give it a minute or two here. If we don't get any questions, then I'll move on to the next section. But I will also add that I am putting in, if you don't feel comfortable putting a question in the chat or you don't think of it, I have also put into the chat window my calendar. If you want to schedule a time to chat with me, I'd certainly love to do that. You can, of course, email me, or you can go right to my calendar, which is now on the chat window. So let me know if you guys have any questions on any of the stuff that I talked about. We'll get into the next slide here in about a minute or so, okay? All right, I will move on to the next section. And this section is just going to talk about the different types of homes that are out there that people can buy or people can purchase. There are single family homes. Now that's going to be a home that you're going to purchase that only one family lives in it. It's not going to be a duplex or a triplex. Condominiums is another program, another type of home, excuse me, that people can certainly purchase. Those are going to be the properties that, a condominium, you as a condominium owner are owning the property, but you're not really owning the land underneath the property because you have a neighbor. You might live in a condominium complex where there's people above you, people below you, people to the left and to the right of you in the same building, almost like an apartment, but you own that particular property. Manufactured homes are homes that are not built on the particular site, so not on the land that is also part of it. So that's what differentiates a manufactured home from a single family home. Single family home is built on site. A manufactured home is built in a factory and then delivered to the site. New construction, self-explanatory. If you're looking to build a property, is there a loan program that's out there for you to build a home on some land? That's a type of a home. A non-warrantable condominium. I mentioned that when I talked about non-QM or non-qualified mortgage loans. Non-warrantable condominiums are out there. If a condominium does not meet the certain rules of Fannie Mae, Freddie Mac, and the others, they call it a non-warrantable condominium. That is something that wouldn't necessarily lend conventionally, but we do have programs out there that you can get into to get those properties. An investment property, Brian, a property that you want to use to have people move in and rent from you, make some money off of it. You see that going around a lot. It's definitely a very good way to build wealth and having investment properties. Vacation homes and second homes are about the same thing. A vacation home is, something that's going to be more vacation-y, whether it's Florida or whether it's the Wisconsin Dells. A second home might be a home up north on a lake or, just some hunting, a home where you go hunting. Any questions about the type of loans? I do see, Max, that you asked a question, and I'll get to that in just a sec. But at this time, more questions about any of the stuff that we've gone over so far, please feel free to shoot a note in the chat. In case you wanted it again, if you have any questions on this section, I put my calendar link in there again for you. Now, Max, you mentioned for a VA loan, your dad's a vet, and you believe that you as his son are able to get a VA loan. Is that true? Well, there's a little bit more to that. It is not true unless you also are a veteran. So in other words, you have to also be a veteran in order to utilize that program. Now, a spouse would qualify to utilize the program. So your dad's wife or significant other, I guess I should say they have to be married, would have to also be, would be able to utilize the VA loan program. Now, children, relatives, anything like that, you wouldn't qualify based on them being a veteran. There are some situations where you could, but the veteran would have had been killed in action, and they obviously, were killed in action or were disabled in action, and you were the only person that could, or you were the only surviving heir to that person. There's some situations where that would work. But generally speaking, if you're not a veteran, 9 times out of 10, you're not going to be able to utilize the VA loan program. But there are plenty of other loan options that are available for you as well. Any other questions? Please feel free to put them in the chat. Otherwise, I'll go on to mistake number 2. All right. Mistake number 2, ignoring sources available for down payment and to pay for the fees of buying a home. Okay, part of that, not finding out how you can get money. You don't necessarily have to have money in the bank. You can find other ways to do that. And this section kind of talks a little bit about that. So what are sources for down payment? These are pretty much the sources that are available for down payment. Your own money, of course, very simple. A gift from a family member, close personal friends. And when I accentuated that, close personal friends are going to be someone that you've known for a very long time and really has a vested interest in seeing you do better. It can't just be your buddy that you play softball with. It has to be a close personal friend that you can document. That one's a little hard. Now, your employer certainly can gift you money as well. And then there are charitable organizations out there that also gift money. There's some programs out there for down payment assistance programs out there. It's county-based, city-based, state-based. I mean, there's different programs that are out there, and that's something I can certainly help navigate through. And those down payment assistance programs make up 2 things. One, obviously, you can get a down payment assistance loan, and that's something that you're going to pay back, as well as the other mortgage, the primary mortgage, or you can get a grant. Now, the way a grant works is it's kind of like, a grant that you get for a student loan. You're not having to pay that back. Just when you sell the property, then at that point you pay it back, but you don't have interest that accumulates or anything like that. Some other sources of down payment, getting a second mortgage on a house you currently own. So if you're looking to purchase a second home or investment property, taking out a mortgage on your current home, if you have the equity, is certainly a great source for down payment. Sometimes it's one of the best sources because you can get low interest rates on your primary residence, and that can help with down payment, which can also help with some other things that we'll talk about in the future. If you're in a home right now and you want to sell that to buy a new one, that is certainly something that you can use as well. Securing a loan on an asset that you own, selling real property, those 2 are the same thing. An asset that you might own, maybe real property, an automobile, guitars, art, jewelry, stamp collection, sports memorabilia, stuff like that. Those are things that you can use to generate a down payment. There is only one primary thing that is extremely hard to use, and that is cash that's held at your home, and you just want to use that for down payment. We have to have the ability to source the money and prove where the money came from, and also be able to document that as well. And cash at home really isn't documentable. Now, if you're in the service industry and you get a lot of tips, what I generally tell people to do in that situation is, or in situations where you do have cash at home, is, start the process by putting as much money away as you can if you're needing a down payment, and putting it into a bank account. As long as we can have 60 days between the deposit of all your money that you're going to use for down payment and closing, then we don't have to worry about documenting it, because we only have to worry about documenting assets and down payments for the previous 60 days. Excuse me, I'm gonna take a drink here. Closing costs and prepaids are fees that you're going to pay when you buy a home. When you buy a home or refinance a mortgage, there are always costs, just like any other purchase that we have. People will say, oh, closing costs are outrageous. But when you actually look at it, in this example that we have here, excuse me, we'll pretty much explain that they're not outrageous in comparison. So let's compare a mortgage to buying a candy bar. I know it sounds silly, but if you buy a $100,000 home and the closing costs are about $4,500, that's kind of normal. Now, closing costs and prepaids are going to be talked about, so you're going to understand it's not just costs to get the home, but it's also prepaid items, stuff that are going to be prepaid on your behalf to help with that. Now, imagine if you bought candy bars, $100,000 worth of candy bars. You're going to pay 5.5% sales tax to the government. If you take that and do that as a number, that's $5,500, which means it's going to cost more to buy $100,000 worth of candy bars than it is to buy a house. That sounds silly and all, but it's kind of a point there, is to make it sound silly, is to show you that it's really not outrageous when you talk about the sheer magnitude of the product. So let's talk about closing costs and prepaids. Closing costs are listed here on this page, and these are the stuff that are going to be fees that we're going to be incurred to help you get a mortgage. There's going to be an appraisal fee. It's going to show us what the value of the home is. There'll be processing and underwriting fees. That's going to be stuff that are going to be paid to the party that is going to be helping get the paperwork through to get your loan, to get your mortgage. So verification, stuff like that, as listed a little bit further. We have to order what they call a flood certification. We got to determine if you're in a floodplain. That's a requirement. So there is a fee for that. Potentially there's a fee for a credit report. We have to order a credit report in order to get a mortgage. We have to prove your ability to repay. I tell people all the time, there's the 3 C's of getting a mortgage: credit, capacity, and collateral. Credit is the biggest part of it. So that's a very important factor. And we'll talk about more at the later. As we go on, other verification fees, if you're buying a condominium, maybe that condominium is something that you're going to, we need to prove that it's, excuse me, lost my train of thought there. We have to prove that the property is a warrantable condominium. So we may have to get a condo questionnaire filled out to answer some of those questions. And sometimes they charge a fee. Sometimes there's a fee when we have to verify employment. Title fees. There's fees in which the title company is going to charge in order to do title work. And that's something that's a very important thing for us. There's a lender's title policy. Again, it says see further in the back, but let's add to that. A lender's title policy is an insurance policy for you to ensure that you're getting the house free and clear. Government recording fees. we're going to have to record the deed and the mortgage in your name and attach the mortgage to the recording on the property. And there's a fee that they charge. Discount points. Those are fees that you're going to pay if you want to buy down to get a lower interest rate, to maybe qualify for more or maybe have a lower mortgage payment. There certainly are other fees that are dependent on the individual transaction. Prepaid items. Prepaid items is an expense that is paid in advance of when the money is technically due. So what does that mean? It's something that is required for you and you're prepaying it. So you're going to prepay daily interest, and that's from the day of the loan closing until the end of that same month. You're going to need home insurance. A lot of time you hear the word hazard insurance. Homeowners insurance is something that you're going to pay, and you're always going to have to pay the first year in advance. So of that $4,500 range that we talked about, these fees are also part of it. It's not just closing costs. Flood insurance, if it's required, you're going to have to pay the first year of that. Of course, you're going to have to set up an escrow account. Now, an escrow account is something that is required to cover the homeowner's insurance and the property taxes for when they come due. And if you're not putting 20% down on a home, you're going to be required to have an escrow account, and there's fees for that as well. And prepaid items for that as well, excuse me. If you're buying a condominium, the first monthly amount is something that you're going to do. Now, again, similar to the down payment options, closing costs and prepaids can be paid for through all these different options. So you can use your own money. You can get a seller credit. So you can ask the seller, hey, can you help me? I'll offer you a little bit more on the home, but could you help me pay for some of the closing costs? And they can certainly help you pay for that. Generally speaking, that's something that's just a conversation when you write an offer on a home. A lender credit. So that's a credit that I give you for you. Instead of paying discount points, you want a credit. So you have maybe a higher than normal interest rate. And therefore I give you a credit because you're slightly higher. So we're going to earn the interest over the life of the loan. A lot of times people are going to tell you, hey, we have no closing costs and there's no cost to do this. Well, that doesn't necessarily mean that there aren't costs. It just means that they're giving you a lender credit to cover all that. So therefore, what generally happens is the interest rate is going to be a little bit higher. So you really want to look at these things. You really want to figure out apples to apples. There are programs out there for down payment assistance as well. There are some assistant grants where you can get, $5,000, $6,000, $7,000 to help with the closing costs. Of course, you can use any of the other, getting a second mortgage, selling your current home, selling real property. Again, you cannot use cash. It has to be in your bank account for months in order to use that. Does anyone have any questions on what I've talked about at this point? Okay. All right. Again, please feel free to click on any of the calendar appointments, and you can schedule a time with me to talk in the future if you want to do that. Mistake number 3, not getting a pre-approval. A pre-approval is when a lender obtains details about your financial and credit history, your actual credit report, income. So we actually collect income documentation, and then also money that you have for down payment and costs. That information is different for each loan type of how we have to verify it. So we run it through what they call an origination or a risk software, and it's going to kick back and tell me, are you pre-approved at this dollar amount or are you not, based on the information that I put in. The art of being a good loan officer is knowing the tendencies of the software, and having done it for a long time, it can help make it easier for you to get pre-approved. So a pre-approval is going to identify your price range that you're going to qualify for. It's going to estimate your monthly payment. Now, it's not going to give you an exact monthly payment because we have to know what the house is that you're buying before we can really give you an exact monthly payment. It's going to identify all the different loan programs that you qualify for. It's going to narrow it down. And the biggest thing it's going to help you do is it's going to help you to write an offer. It's going to get you a letter from your lender stating that we have checked your numbers on the house that you're making an offer on. So it's going to make you look like a qualified borrower. Any questions on this section? All right, let's go on quick since there's just a few of us in here. We'll go on to mistake number 4. Now, this is kind of an important. I want you guys to take note of the next screen. Not paying extra on your mortgage each month. Yeah, you only have to pay the minimum, but if you get a 30-year mortgage, you're going to be paying that same minimum for 30 years. So as we look at the screen here, we're purchasing the same $225,000 property. We're putting the same down payment down. We have the same loan amount, the same interest rate, the same term, the same principal and interest. The differences between 1, 2, 3, and 4 is the extra payment towards principal. So number 2, you're putting an extra $25 into your payment. 3, $75, 4, $150. It's going to show you your total payment, and then it's going to show you how much interest you have paid in the first 5 years on each option, the first 10 years, and all throughout the full 30 years. As you see in the orange section, if you compare option 1 to option 4, you're paying $50,000 less interest on that loan. And as we go down, it shows you what your balances are 5 years, 10 years, and 20 years. And then at the very bottom, it's going to show when is the loan paid off. If you can afford to make an extra $150 payment, you're going to go from paying a loan off in a full 30 years, and you're going to cut it by almost 7 years with an extra $150 a month. That's a lot of money for sure. Any questions? Anyone want me to go back to that screen so you can take a look at it again? Please let me know. All right. The last mistake, pretty simple. Not using a loan officer who doesn't know the basic lending rules and then how to solve problems. So if you don't have a person that's been in the industry long enough or a decent amount of time, and they don't know the basic lending rules, it's going to be hard to know what you're going to qualify to. So it's going to go back to qualification and pre-approval. And then, of course, if you do get pre-approved and then you find a house, being able to solve the problem if something was to come up and not just pre-approve you and then turn around and say, I'm sorry, your loan's been denied. So making sure you work with someone is going to be very important. And why is that a money mistake? Well, there's going to be costs that you're going to do when you buy a house. You're going to have to put up what they call earnest money. Now, earnest money is like a deposit on a security deposit on a rental agreement. That could be anywhere from $500 to $5,000 I've seen. That money is put there to the seller saying, hey, I am a good person to buy this property. Take your house off the market. We're going to close. Well, you're putting up all this money. You want to make sure that you can work through it if something was pop up. If you decide to buy a home and you want to get an inspection on it, once you order a home inspection, and now a home inspection is different than an appraisal, but I'll get to an appraisal in just a second. A home inspection is going to cost you, $300 to $500, and it's going to tell you what's wrong with the property. Well, if something comes up and you get denied, you're not getting your $300 to $500 back. Same thing with an appraisal. An appraisal is something that we order, as mentioned before. It is a cost, and that's going to range anywhere from $500 to about $700. Again, just like the inspection I just mentioned, once this has been completed, it is not refundable, and it is something that you prepay. So there are 3 things that you're going to prepay, and not having someone that has the experience and knows how to solve problems is going to be a detriment and it's going to be costly for you. Anyone have any questions on this section? All right, we're getting through this. Let's go into some extra mortgage information. Non-market things that affect your interest rate. So things that don't happen within the mortgage market and all the news we hear that are going to affect your interest rate. Your credit score. The higher your credit score, the better your rate's going to be. How much of a down payment you have. The larger your down payment, the more equity you have when you in the house that you're going to buy. Therefore, as it says, the larger the down payment makes the lower the interest rate because there is less risk to us as a lender. Because if we do end up having to take the property back, we have some equity. The actual type of property, you know, an investment property is a little bit riskier of an investment, so the interest rate is going to be higher. Mortgage insurance. Mortgage insurance is an interest rate that you pay because you're not putting a percentage down. And it's an insurance policy that protects us as a lender in case there's a foreclosure. What your loan amount is. Interest rates are going to change based on the size of the loan amount. The higher the loan amount, the lower the interest rate. Because as we go throughout the life, as we talked about interest a few minutes ago, as we go through the life of the loan, what ends up happening is we're collecting more interest on the higher loan amounts. So there's less risk to us because we have a guarantee if you make your payments, we're going to get a little bit more interest. So we can lower the interest rate for that reason. The length of time for the loan. If you're going into a loan of 30 years versus a 15-year, the longer the time frame is, the more the economy or more the market impacts the rate. We've seen this going over the last 6 to 8 months now. When this happens, a 30-year mortgage, we have to predict what our risk is going all the way out the next 30 years. Well, the interest rate 6 months ago or 8 months ago was 3%. Now maybe it's 6%. Well, that's a big swing. If we're only earning 3% on that versus 6%, there's more risk. And then, of course, a 15-year loan is a lower interest rate because we're closer to that number. The last one is the length of the interest rate lock. Again, once we lock an interest rate in, that's the guaranteed rate for you. If we have to lock it in 60 or 90 or 120 days, well, the market is going to fluctuate in that time period. You know, just like I said a second ago, 60 days ago, interest rates were maybe 5%. Well, now we're closing on your home and you're at 6%, but we gave you 5%. Well, there's loss of income, and no one likes, as lenders, like to see that. So the longer the time frame of the lock, the higher the interest rate could be. Now, it's not going to be 1% higher or 0.5% higher, but it's going to be hundredths of a percent or tenths of a percent higher. Discount points. Talked about this as one of the potential costs. Discount points are fees or points or fees that you're going to pay to lower your interest rate. You're going to end up paying an upfront fee for that. Lender credits are going to lower your closing costs in exchange for accepting a higher interest rate. There is going to be a very important factor to figure out. Does it make sense to pay points to get the lower rate? And that is a simple calculation of how much is it going to cost you versus how much is the difference in payment. And when you calculate that, you get the number of months it takes to break even. So if I tell you it's going to cost you $2,400 and I'm going to save you $100 a month, simple math says it's going to take you 24 months or 2 years to break even. Now, if you're for sure going to be in the property for that 2 years, well, heck, it makes sense to pay down your rate. Now, you may not have the ability to do that because you don't have the funds available. So therefore, a lender credit is going to do the same thing, but it's going to work in reverse. In other words, I mentioned you're going to get a higher interest rate, but you're going to have a lender credit to pay for your closing costs. Well, again, the same number is calculated, except it's done in reverse. if I give you $2,400, if you have $2,400 less in costs, and it's going to cost you $100 more, well, again, if you're going to sell the property within that 2 years, or you're sure of that, then it doesn't make sense to get a lender credit. Hopefully that makes sense. Parts of a mortgage payment, there's principal, there's interest. Principal is the amount of the loan that you're getting and how much you're going to have to pay back. Interest is a fee for getting the privilege to buy or to borrow the money. Home insurance, that's going to protect your house against damage. Property taxes is an assessment on the house, making sure that you're paying the county or the city or the village. Mortgage insurance, we talked about this. It's going to be a charge or a fee that you're going to pay, or percentage that you're going to pay. It's going to give an insurance policy. So if we have to take the home back in foreclosure, and it only is something that is required when you have less than 20% down. Now, there are a couple programs out there that are always going to require it. And there are a couple programs out there that don't have mortgage insurance, no matter what your down payment is. And now, Max, we talked about VA loans for a moment there. VA loans do not have mortgage insurance, no matter whether you put a penny down or not. FHA loans and USDA loans will always have it, no matter if you have 50% down. If you need to have flood insurance, you need to have condo association fees or home dues, homeowners association dues. Mortgage insurance, you can buy out your mortgage insurance. There are options. You can pay a single premium at closing, which is an additional cost. It's almost like you're paying a discount fee, but we're removing the mortgage insurance because we're taking that money and we're pre-filling into an insurance policy. Again, we can do a lender credit to pay for that as well. There is a one-time fee that's paid, so either you pay it or we pay it. And that can help save you some money. I get this a lot. Why are credit scores different? Credit scores are different because there's 3 primary credit reporting agencies: Experian, Equifax, and TransUnion. And inside of those, there are 28 different FICO score models that are used, or calculations that are used. And if you look at this, one creditor or one person that's going to pull your credit may look at it and say, we're using FICO bank card score 8. And one might say that we're using FICO score 5. That being said, they're going to have different credit scores. A perfect example is you look at Credit Karma and you look at all these places and they talk about interest rates. Well, their interest rates are going to be different than, or not interest rates, excuse me, their credit scores are going to be completely different than ours. As we have listed here, you can get a little bit of information or education about credit scores. I've actually, I'm putting into the chat the link that I just have right here that says myfico.com credit education. Credit repair. If you're afraid that you don't have good enough credit, there are ways that we can help improve your credit. Again, there's an informational booklet that I'm adding as well to the chat window. And if you want to click on that link, you can download the booklet that's going to talk about repairing your credit, making sure there's not any errors on your credit. On the next slide, how can we help you improve your credit? Well, there's things that you can do, and that's not having a big, huge mix of credit types. Installment loans, revolving accounts. Installment loans are car loans, boat loans, RV loans, UTV loans, stuff like that. And revolving credit is credit cards. Making sure that your credit card balances are less than the max limit. Now, the perfect amount of credit to the limit is 10% of your balances to the max limit. It says don't close credit cards that have great histories or long history. Medical collection, something new that just came out. If you have a medical collection on your credit and you pay it off, it gets deleted from your report. It never doesn't stay there anymore. So collections impact your credit score negatively. And if we pay off, it's a medical one, it's going to impact your score. If you pay it off, we may not have to, your credit score may be improved because of that. You know, making sure that, you know, non-medical collections out there are also taken care of. You know, you can negotiate with the creditor or the collection agency to see if they will remove if you pay them. Making sure there's not any errors on your credit report. Like there's not a late payment that you are for sure there isn't one. Another great thing to think about, which is phenomenal for people, is what's called the mortgage credit certificate. And this is a program that is great for first-time homebuyers, veterans, and if you buy a house in a HUD designated area. So HUD is a government agency that if you buy a home in there, you can utilize the mortgage credit certificate. And it's this program that gives you a dollar for dollar tax credit up to $2,000 every year you own the home. There's a one-time fee that's charged for that. It's not a big fee. I think it's $600 going right now. There is a limit on how much income you can have, and it's based on the county that you're buying in. And your household income has to be below that. It can be used on any of the loan programs. Now, the $2,000 credit that I'm talking about is when you do your taxes and you get to your bottom line and you get your refund. Let's just say your refund's $2,000. Well, this credit here turns that refund into $4,000. So it's almost like you're getting free money. It's kind of like the earned income tax credit. It's a credit that you get after you go through all your numbers to figure out what you get back. A few more slides to go, people. Things not to do well in the mortgage process. A lot of these are pretty simple. Don't buy or lease a new car or open any new debt. Don't quit your job or change industries or start a new company. Again, we have to know what your debt to income ratio is, and we have to be able to prove your income. So don't quit your job or go into business for yourself. Don't go from a salary job or an hourly job to a commission job. Don't deposit large sums of money that can't be documented. Don't forget to pay your bills. Don't open new credit cards, even if you're getting 0% for 5 years or you're getting 20% off your next purchase. No Kohl's credit cards. Now, this is while you're in the process. This is not before you've been pre-approved. Once you've been pre-approved, follow these steps. Don't make big purchases. Don't close any credit cards. Don't accept cash gifts. Don't make undocumented deposits or random deposits into your account. Don't spend the money you have set aside for closing. Put that money away. Don't do any of the above. Do not co-sign for someone. If you co-sign for someone, it is a debt that goes onto your credit report. And if it goes onto your credit report, we're going to have to make that into a ratio into your payments. So in the 3 C's of buying a home, we talked about credit. We talked about capacity. We talked about credit. Let's talk about capacity. Capacity is what is your ability to repay the loan. And so you don't want to have too high of a debt to income ratio because it's going to be harder to qualify. So don't co-sign, even though they're making the payments, we have to wait 12 full months of them making a payment on their own in order to not include it in your ratio. Of course, if you're in the process and there just something has to happen, the sooner we know, the sooner we can work through it, the sooner I can problem solve. What happens in a first call with me? We're going to learn about your mortgage payment goals. We're going to take a quick synopsis of your income. We're going to talk about your debts. We're going to talk about your credit. We're not actually pulling any of these things in. We're talking about them. So having that information is going to be very, very beneficial. If we decide that it makes sense for us to go on to the next step for pre-approval, then we'll start collecting that stuff and pulling your credit. Once we have this, we can kind of do hand math. We can figure out what you're going to qualify for, and we're going to be able to talk about mortgage options, all the ones that you're going to work with. These are just, if you want to take a look at me, you can certainly go on Google, search for my name, Rob Miller, Provisor Madison, or Mad City Home Loans, Rob Miller, and you can find reviews on me. Here's just a couple of the reviews that I've gotten. Of course, if you also click on the QR code, you're going to get that as well. What are the reasons for booking a time with me and going to my Calendly link or emailing me or calling me? You have questions and we didn't get a chance to talk about it in this webinar. You want to understand more about your personal mortgage options where there's no credit check. You have some concerns on your credit and you want to just talk about it and you want me to kind of work through it with you. You would like to do that formal pre-approval. Or you've talked to another lender and they either said, nope, we can't help you, or they're wishy-washy, or you're not understanding something that they told you. If you think of any of those things and you'd like a booked time with me, certainly go onto my calendar, email me, or call me. Do we have any other questions? Otherwise, our time's just about running out. And Max, I know with your question, if you want a little bit, we can talk a little bit more off line. If you want to give me a call or schedule a time, I'd certainly like to talk to you a little bit more about VA loans. I do specialize in VA loans. I've been working with them going on 20 plus years, like I said, but I have really worked the ins and outs of them, and I'd love to chat with you more about them. Okay. Sounds good, Max. Again, my last slide, just my contact information. Click on that QR code, get my contact information. Other than that, if no one else has any other questions, I appreciate you coming to my webinar. If you know anyone else that is in the process like you guys are, please feel free to give them my information. I will be having another one next month on the 20th. Other than that, if we have no other questions, I'm going to shut down the webinar. Thanks for your time and have a great evening.